Junaid, maybe kick us off a little bit here with why we're here and why McKinsey.
Yeah, well, thanks, Peter. Good afternoon, everyone. It's great to be here in Dublin, Ireland. We are from McKinsey. We're part of the fast growth team. You probably know McKinsey traditionally from the work that we've done for the past 90 years, right? Big clients, traditional kind of engagements. We're part of a group that came up about 3 or 4 years ago. Peter was one of the original founders, an entrepreneur inside the company, founded the practice, and the emphasis is really on helping entrepreneurs, working with people like you all, working with investors, helping to grow companies, achieve value. This is an initiative that is unique for McKinsey, right? We had to go out and recruit some new DNA in the company. So we brought people on like myself, very atypical backgrounds, perhaps. Once upon a time, 10 years ago, I did work at McKinsey. I did a lot of PowerPoint slides. I put a lot of people to sleep, took a lot of airplane flights. And 10 years from there, I did a lot of product stuff, engineering, product management. I ran sales. I did 2 or 3 startups. One of them had an IPO, did very well. Another one was seed stage through roughly Series B, raised about $35 million, still in business today. They're at Series C. Our team is small, but it's filled with people who have great experience in startups, building companies. We've had exits, IPOs. We've had a lot of great things happening. And so this team is really focused on research and driving content that I think will be valuable to you all as you're thinking about how you actually get from Series A to B and C and D and so on and so forth. And that's the gist of what we're going to share with you today. So Peter will have some slides, and we'll take you through that. We're going to make sure we leave a lot of time for Q&A. So the goal here is to get at least 20, 25 minutes of the presentation for question and answer through Slido. With that, why don't I turn it over to Peter so he can do an introduction of himself and then dive right into the content.
And who I am is probably a little bit less interesting. Please use Slido, record your questions. I find that this is most exciting as an audience that we're going to participate. I'm going to kill you with these slides because I'm going to go way too fast, and that's purposeful. I don't want to be presenting these slides at all. But let me tell you what we did. So as we began the practice, we started, kind of in a hierarchical fashion, thinking about the problem-faced growth stage businesses in a few dimensions. The first, what drives value? And by the way, that's not valuation. Value is 3-year returns. Valuation is what you're worth today. I want to ask the question, what is going to create sustainable growth and the enablement that you can actually become top companies? And if you knew that, what would it imply about how you would actually look at your business, how you metric that business, and turn those things not into a lot of the metrics that we wrestle with today, because there's hundreds of them, and the problems associated with those, but into things that are actually operationally practical and allow us to make some decisions. And if you knew those things, could it just be math to help you understand where you might prioritize your time as you're continuing to improve the performance of your business? And behind all of this, we have been benchmarking a few hundred growth stage SaaS companies in partnership with a number of the leading venture funds that we actually work with. And so we're going to actually inform this with actual data that comes out of it. Plus, from a second data source, we took every software company back to 1980 that had essentially made it to 50 million in revenue, which is actually like, I've overstated it, we got about data from about 2/3 of them, but they're the ones that you can get data from. There's been about 5,000 that have made it to 50 million since 1980. Of those, only about 400 ever made it to 500 million in revenue independently. That was shocking to me. I was actually frustrated because you think about it, if you're a $50 million revenue company, do you have a pretty good product? Probably. In fact, I would probably assert that all of those were pretty amazing products. So it wasn't the technology that was holding them back likely. It was actually probably their capability of growing. And what if we even added just 100 more companies to that list, made it 500 that made it? How would the world be different today? What could we do and learn from those companies that have made that successful journey to allow us to all be more successful than we currently have? And that was something that got me very excited and why I, essentially did something that's risky in the McKinsey world, which is decide to do something different. And look, it's been pretty interesting. Behind every one of these, imagine there's 20 more slides. So if you got interested, I've spent like days with entire venture funds on single ones of these slides here. So ask us. We'd be happy to share more. What I said when we did that set of analysis looking at those companies, maybe the answer is not that surprising. We talk about the importance of growth already. By the time you get to 50 million, the litmus test of whether or not you're likely to make it to 500 million historically has been literally, can you grow at least 50% per year and do that pretty sustainably through 100, 150 million? And by the way, after 150 million, it kind of ratchets down a little bit to about 35 to 40%. But the point is, you have to grow fast. And by the way, those businesses that have historically, if you invested in those businesses at 50 million, how much money do you think you're going to pay for them? A lot of money, right? It's not like it's a hard-to-see business at that point. There's a lot of investors out there, so you're going to pay through the nose. As a portfolio, that set of companies still returned 4 to 5 times more if you had invested in them at that point 3 years later than the portfolio of companies that were growing slower. You paid through the nose, you still earn more money. This is a little bit of what Andreessen talks about, right? I'm just going to pay for whoever's fastest. It doesn't matter how much. And then the other side, this is why. 51% of those companies that were growing at that rate made it to 500 million. So you can still have intense outcomes. And if you're investing in late stage, that's the only way you're going to get really good returns, is if you actually have businesses that actually get big and not just look like they could get big. And why is it important? It's because of this. On average, and you could see a whole bunch of people have done, David Scott has a really good version of this. This is one that I did with Neeraj Battery. But you look at it, on average, any segment that gets a player that gets to 50 million, there's going to be about 20 to 22 other competitors in that segment. The number one player in that segment, we've checked it over time, and the number has stayed pretty consistent. The number one player, on average, gets somewhere between 70 and 75% of the total equity value of that segment. That's why it's important to be number one. That's why it's important to grow faster than other people, because if you have that, what can you do? You can raise money more cheaply than your competitors. You can acquire other companies more cheaply. It is easier for you to stay ahead. So the question I have been asking myself is, what would I need to do in a business by the time I got to 5 or 10 million in revenue, I have product market fit, to put me in a position by the time that I'm 50 million in revenue so that I can sustainably grow and have those advantages that nobody else in my peer set is going to have. By the way, are there exceptions? Yes. If you want to talk about exceptions, we can do it. I'm just telling you that this is the vast majority of the success cases. So if you are an exception, we can see if you're an exceptional child. But I'd rather play the odds a little bit. By the way, this is all backed up by the problem that we all face. And this creates very bad decisions. This is just the chart of valuation multiples for SaaS companies over the last few years, all over the place. If you are making decisions about the amount of money you need to raise based upon the amount of money that you can actually raise it for, the chances that you're putting yourself in a position where you are going to underinvest in your growth are much higher. It puts you in a brittle position. It doesn't mean that you don't get lucky and you don't have a competitor that's not in that same position. But this is why we're going to focus on this topic of how do you not just grow, but do you grow efficiently? Because if you had control of your business and you were able to grow fast and grow efficient, it puts you in the conditions where it's much more likely that you're going to be able to sustain that and not be the whim of outside forces that actually can put pressure on your business. And we're doing this within the constraints of how you actually measure your business to figure out whether or not you're efficient, that a lot of these things suck for a ton of reasons. They're very backward-looking. They don't relate very specifically to operating choices that I'm making. They don't necessarily play well with GAAP, and this is not me telling you that I like GAAP, but I will tell you at least GAAP is consistent. And if you ask two people to tell me their churn number and I have no idea how they calculate it and I try to compare those things, is that likely to be a very good outcome? There's a tremendous number of reasons why these things struggle. And in fact, I was just with Seth, who built the Rule of 40, and he and I have been talking about a lot of the things that we don't like with that. There's just so many things that feel good, but when you actually get into them, they have a whole bunch of challenges with them. And so we've been working on with a number of our our friends is how would you look at this a little bit differently, trying to solve many of those things. And this gets at a little bit of what Rule 40 was trying to do. What if you looked at the business and you said, I have a cash engine. This is the set of my business of customers I have. And by the way, I'm in a subscription business, so I'm continuing to earn money from those customers. But by the way, you can apply this to non-subscription businesses. What would that tell me about the amount of money I'm earning? If I stopped spending money on growth, would it at least throw off cash to make me happy? And what does good look like on that? And by the way, you could ask questions like, Peter, you're an idiot. You stuck R&D over there. R&D is for my growth. What would happen if you stopped spending on R&D? You think you'd have your customers anymore? You think you have competitors that are not, building better products? Most of these places, you're spending money on R&D to stand still or like at least have slight advantages relative to other people. This is about keeping that business going. Now, you can make an argument, look, I can split out some R&D for some new product lines. Okay, there's some ways to fudge this. And this isn't perfect. This is just efficiency of spending those dollars that you get. A lot of us spend 150% of those dollars over there. But if you had a business and you knew you had to grow 50% per year, you could do maths and ask yourself, where I am today, how fast could I grow if I was just breaking even? And what would I have to do differently to grow 50% per year at breaking even? Because again, when people ask me the question of like, how profitable should I be, to me that's a management choice. Profit is just a mixture of these two things here. What you really want to ask is, how good is my business at growing and throwing off cash to put me in a position to stay ahead of others without having to take money from other people to grow fast enough? And by the way, some of the interesting things here when we get into it, like on the Rule of 40, the Rule of 40 is interesting, but the derivative's even more interesting. We can talk about why that is. We could talk about, some of the failures around all the companies that get really high marks often on these things can't grow very fast. So it's unlikely that they're going to be long-term successes. So very interesting side conversations. And we like this, though, because you can actually take every one of these things and turn them into very specific operating metrics that relate to a behavior that you do in the business. By the way, again, this isn't perfect. Like, there's some things on here, and we'll give you some indicators of them in a second, that are not included. Like, pricing is a huge lever that doesn't metric very easy. How do we deal with stuff like that? And when you look at these things here, some of the other benefits we've been looking at and some of the things that we've been pushing for is there are too many accountants making these metric lists, which means that they look for something that, at McKinsey we call measiness, which just means like mutually exclusive, collectively exhaustive. You may have heard this thrown around. That is a terrible way of looking at businesses because we don't operate businesses in a measy way. If I change that pricing lever I just talked about, is that going to change things on other, my sales efficiency? Hell yeah. I want to look at my business through the operating levers I have control of and calculate how much value I could get out of changing it. Screw the fact it's going to change my R&D efficiency. I need to know that. So I need to look at them in a non-measy way, and that's why some of this is quite important. And that brings us to the levers. We've worked with hundreds of growth stage businesses now, and the common opportunities they have is striking. It's like a dozen things that are the very common opportunities. And by the way, there's a fifth thing that we're going to stick on here that we often keep off because, honestly, as McKinsey, we're embarrassed to throw it out because we don't want people to think of us as strategists. But your strategy is really important because it affects all of these things. And I don't mean strategy in like blue sky thinking strategy. I mean strategic decision making. There's a tremendous amount of companies that I deal with that because they actually have so much opportunity, they pursue it all. Do you think you're going to likely have success if you are pursuing all those opportunities, or if you had some focus? So we have a bit of embarrassment of riches situations. We have the opposite sometimes. I started in a niche, feels too small. You got to make a decision. Am I going to try to roll up that niche, or can I step out? See people try to do both. Some of those things are going to affect the efficiency here. Like one of the businesses we worked with had one of these, 40 million ARR, growing 70% per year, going to raise a round. Everybody said, I don't know what you're going to look like in 3 years because you're telling me like 40 things you're going to potentially do. They were getting hammered on their valuation. And then by focusing down to 7 things that they knew they could get another 80 million ARR in the next kind of year and a half, their valuation went up overnight 30%. That was just a decision that caused their valuation to go up. They finally made some decisions. The other thing that happened? R&D figured out that 15% of the projects they were working on were not part of their future. Redeploy 15% of their R&D capacity to other things that were actually directly related to the products that they were going to be selling. The sales team got 30% more efficient because all of a sudden they were not trying to sell 40 visions. They were selling 3 that was this year and things that were going to naturally come. That's why I say it has knock-on benefits. This was an answer of frustration around the valuation that turned into value in a lot of other places in the business. And the beauty is this is math at this point. I can take a business, it's just like an average business from our benchmarking database, and ask a simple question of, dumbly, if I could improve by 25% any one of those levers, how much cash flow value on that cash engine would that generate? And that could help you perhaps prioritize where you're going to focus on in the short term. And sometimes it says things like the number of board meetings I go to where everybody's focused on retention. Yeah, and retention's important, but it may not be something where an improvement is very likely or very valuable, so it's nice to look at it. But why the hell aren't we spending time on pricing? And we're usually not spending time on pricing because it seems like a really big intractable problem, not because we don't see that it exists as an opportunity. But when you could start to enumerate how much that could potentially be worth, maybe it actually raises in terms of priority. And I'm not going to go deep into this, and this is where I'd love to get some of your questions, but behind every one of these levers, we've got really deep sets of data around things that we've observed, common challenges. And by the way, ask interesting questions, not just here, but later. Part of the reason we love hanging out with the smartest VCs is they ask great questions. Example is one of the VCs that we worked with, essentially said, hey, here's 5 things that we've been seeing, brought up in board meetings all the time, arguing about what drives efficiency of our sales motion. Hey, we've got data now, let's test it. So we tested some of these, some of them failed, some of them succeeded. But even when they succeed, knowing exactly what that means operationally is important, because just telling you that you're more efficient when you do expansion, okay, maybe that's not too difficult. But how much? When you look at the proportion of investment in expansion, you see that the companies that invest around 10 to 25% of their sales resources on expansion in generally are the most efficient, which, by the way, isn't that surprising because you're probably like feeding fat cows at the other end of that spectrum. You need to stretch people enough, right? And like I said, interesting stuff around very negative correlation to the use of channel partners. This does not say you should not use channel partners. This just tells you that the 200 companies that we benchmark use them very poorly. Because I can give you examples of why channel partners can be very good. It just means a lot of them came out of a world like me. I mean, I got an enterprise software, even started doing SaaS in the late 90s. We called it ASPs at the time, right? We are trying to apply broken channel partnership models that used to work in the perpetuity world that do not work in the SaaS world too often. That's what that means, right? This is what we're trying to avoid. On average in our database, if I ignore the 2.36 is too high because there's 2 companies in there that have a very high number, and there's not as many companies in our database that have like 100 million in ARR, but it holds, this is the valley of death that I talk about. We generally are pretty efficient at selling after we get product market fit because the customers sell for us. Those companies that survive to greater than 50, they generally have gotten relatively efficient, but you see this huge dip in between. And this has a fallacy in it as well, which is our database has companies that are at different sizes. So what you're actually seeing are companies dying in here, because if you take those 50 million revenue companies and back them up, you don't see a huge dip. You actually see companies that are able to ramp up their efficiency through the world. These companies are going to be challenged by their investors to take money at some point, and they're going to get out of them. Pricing, similarly, lots of interesting stuff, tons of decks on this you can go into. This is a fun one. I encourage you to draw this chart. Take all your wins and losses. See if there's any correlation to the price level that you sold it at. I don't think I've ever seen that. If there is no correlation, that probably means you can raise your price because all of your wins and losses are a behavior of your salespeople, not the price at which you're selling it. And there's some interesting things in here you can go into on like, why is it hard? There's a structured way of approaching it. Why don't we approach pricing? It's not because people don't realize it. We surveyed a couple hundred of our benchmark participants. Do you think your pricing's broken? 2/3 came back and said, yeah, we guessed on our prices. Yeah, we know it's broken. We're not solving it because we don't know how to, not because we don't know it's a problem. And there are some structured ways to approach these types of problems, and I encourage you to look at some of these because this isn't about hiring a consultant necessarily to do them. It's about applying some of the principles about how you actually think about bundling. How do you think about units? And by the way, 80% of the companies that we survey use units that are very rarely correlated to the value their customers are getting, yet they will tell you, your customers, went out and surveyed them, asked them, would you pay more if they changed their unit to something that was more closely aligned to value? When was the last time you actually asked customers, would you pay me more? And they said yes. 2/3 of them literally just came back and said yes, I would pay more for that. This is, by the way, an interesting one. This is a little bit of my hobby horse here. An eye chart on the dots, but I will tell you this is how you can afford having a full-time pricing person on your team, which is, this is just a scatter plot of discounts versus the ACV of the deal, the individual deal size. If you don't think that you can hire a pricing person on your team that can get at least 2 or 3% uplift in ACV and pay for themselves immediately, I'd be surprised, because there's a whole bunch of interesting things here. Like, wow, I got a really big deal with only 15% discount. I also got a really big deal with a huge discount. Do you think there's some things that we could have learned about the low discount big deals that we could have applied to the small ones if we actually had an expert that was helping the sales team deliver? Or, what the F? I have just done a ton of deals that are all probably negative margin up there in the upper left because they're pretty small deals that I actually spent time discounting. Why was I even working those things? You also see a lot of banding. This is pretty common. Tons of discounts all done at the same level just because you gave the field authority to discount at that level. I mean, you've changed your discounting authority by 5%. We already proved that they're not, like it's not affecting the win rate. Change your discounting by 5%. So you can actually afford having a full-time pricing person to help you on the first thing through this pretty easily. So, like I said, I went very fast. There's way more than we can go into. This is where I wanted to ask you guys questions, right?
Before you get into questions, let's also offer up for the audience to participate in the SaaS Radar benchmark database that Peter
this
just
is all
presented.
free to participate in, by the way. I know McKinsey's a for-profit organization, and so it feels funny that we give stuff away for free, but honestly, we all get smarter when we do these things, and part of our own building credibility is actually kind of understanding some things where we can actually be helpful. So please participate. We try to give back as much as possible from the work that we do. Yeah,
the way it works is you send an email to saasradar@mckinsey.com. Somebody will get it, and they'll send you back a mutual NDA form. It's a protection for you, protection for McKinsey. Your data of your company is not shared with anybody else. It's aggregated and anonymized for the purposes of researching, benchmarking, operational data, financial data, churn data, various kinds of churn data. And then we come back to you in a couple of weeks and we do a report out. You'll get like a PowerPoint and a spreadsheet with some key metrics for companies that are similar in size to you in ARR and in growth. And in your cohort, you'll get 10 other companies from the database. You won't know who they are, but you'll be benchmarked against that cohort. And you can get some pretty good insights as to where should you be focusing your time, your effort, your resources. And that data is kind of what Peter presented. It's usually pricing, customer acquisition. That's the easy levers to look at. But we encourage you to reach out to SaaS Radar at McKinsey, and we'll get you hooked into the database if you aren't already participating. So feel free.
And can we flip the questions up here? By the way, feel free to shout out. I mean, this is like all very quiet here. I feel like I need more engagement. Are slides online anywhere? Yeah. Well, I don't know. We'll work with Alex to figure out how to disseminate. These slides here are already online. Actually, you can find it if you go to cloudnewyork.com. It was another event that we put on a couple months ago where we built this content for. You can go look at the content on that. Wow, we only have 3 questions. This is a very low engagement audience here. Best strategies for increasing retention. I hope that retention in this particular case is customer retention, because certainly there is employee retention and a whole bunch of other things. So I guess at the most macro level around retention falls into 2 buckets, right? It falls into what a lot of people will call structural retention, and then there's a whole other bucket of retention that has to do with your own performance and whether or not you're meeting customers' expectations. In the SaaS world, especially if you're doing enterprise sales and you have product market fit, that latter one is often a smaller problem. You have very limited churn because most of your customers ought to be happy if you have product market fit. A lot of people, though, they get to, say 10% churn on an annual basis, and they say, ugh, I can't get this any longer because the rest of it's structural. So I'll answer the question around structural because the other one is in many ways maybe more commonly answered. So on the structural side, well, what causes structural churn? Well, one big complaint is I lost my sponsor. Another complaint is my company went out of business. There's a variety of reasons why you might lose them. Structural churn can be reduced. I know it seems strange that you can do those things, but for instance, on the sponsor one, if you're single-threading your relationship in an organization, the chance that you can be pulled out when sponsorship changes, much higher. And it's not just about single-threaded in terms of the sales itself, but have you thought about how you're actually helping the buyer communicate the success that they are having as a result of using your product? And I don't mean for them to tell them anything about your product, to like say, oh, geez, this product has 45% ROI. I mean, are you helping that person tell their boss that their personal efficiency went up 30%? Or they've done 20 more deals, or whatever your product is doing, right? Have you created that dashboard that they are going to be sending to their management team and to other people? You do things like that, it creates incredible risk for anybody to ever replace your product as soon as somebody else comes in. Because that boss is going to be asking for those same reports all the time, and nobody else is ever going to format the report the same way that you did. On the going out of business, the really interesting one, this is particularly big in SMB. I worked with a company that builds the point-of-sale systems in restaurants. And that is an industry where there's an incredible amount of turnover. In fact, the average restaurant, I believe, lasts like 4 years or something in the United States. The really cool thing that these guys ended up doing was building a relationship with the founder of the restaurant, because what do restaurateurs do after a restaurant fails? They go open another restaurant. And so by actually tracking it by the individual as opposed to the brand of the restaurant, they were able to get a much healthier perspective on SaaS and get much stickier on what their product actually was. And they actually got to the point where the retention rate on the founder of restaurants was like 90% when they went to another restaurant, or it was 92%. It's not perfect, but that starts to look like enterprise. And by the way, what happens when you start to communicate that way to your investors? They can start to think of you a little bit more like an enterprise business, and churn and those types of things, which actually give them benefits that they're not used to seeing.
Let me add a couple things before we move on. I know there's some more questions coming in. So on churn reduction or increasing retention, do your cohort analysis. Look at all the customers that came in 2012, 2013, 14, 15. See how that pattern emerges. Understand the feature, function, and the use case root cause for the churn, right? You got to do your homework. We find that in the course of these pricing kind of studies when working with clients, you disaggregate all the feature functions, and you look at which ones are sort of core and which ones are sort of beating the market, or ones that customers are willing to pay for. Where does that value kind of really lie? We've also found in the data that in some cases, now there's a variation here, that if customers pay for trials, they churn less, versus, say, free demos, where there's really no consequence, right? Again, the data varies, but it's a slight differentiator there. So I would just encourage you to do your homework and look at the underlying data in terms of your pricing and why customers are churning. You'll start to see some real nuggets of wisdom in there. Maybe we'll move on to the next question, if that's okay.
Yeah. Well, which one would you like to take?
Let's see. There's a bunch with 5 thumbs up. So can you provide examples of SaaS companies that have recently dominated their sector?
You came from Coupa Software. Come on.
I could talk about Coupa. I came from Coupa. I'll give a plug to Coupa. Coupa came out of 2006. It was the idea that the world needed electronic procurement, spend management. Ariba was the on-prem player. Coupa said, hey, let's change the model and let's actually offer the capabilities to suppliers for free, right? That's a huge difference from the way Ariba was doing things. Ariba was charging suppliers to get on the network, and that was a huge friction point and impediment. So Coupa had a great fast rise over the past 10 years in IPO. I think another one is security. In the security space, it's Tanium. Tanium came out of nowhere now, is reportedly worth $4.5–5 billion, right, in Emeryville, California. Top security player, only number 1 to us when we were in the security space. They dominated the endpoint market. They had a great team. there's no shortage. I think to Peter's point, if you're winning, you're going to get 70% of the equity value in that space, right? And there's plenty of other examples there. So,
by the way, there seems to be, everybody wants to know, we may have had a typo on a page. I agree. You're not going to have gross churn at 0. I think ideally the page said 10% gross churn, and it had a net churn of probably 105 or 110 or something on it. So I agree with all of you that disagree with such a low gross churn.
Here's a great question here. You say that the winner takes 75% of the market. What can we do as a contender? That's a great question. So M&A is still a great way to finish your game, right, in terms of an outcome. And we've seen some companies do very well. AppDynamics got taken out by Cisco this year, or a great exit for them. There's a ton of opportunities for the number 2, 3, 4, 5, and 6 player in the market. In most cases, there's a suitor, a strategic suitor, and there's going to be a second suitor and a third suitor and a fourth suitor. You got to keep playing in the game, and you got to keep striving to be the best, right? The capabilities and what you become known for in the marketplace for your value will very much dictate which suitor comes along. But I think it's really thinking about it in those terms and sort of how do you build a company for the attractiveness of a likely target. So,
well, and by the way, on the contender point, these markets are not static. This is about winning a segment. What you need to do is you need to find a niche that's uncovered. Is Slack a terrible company because they went into the communication space that's been around for 30 years that everybody's been trying to do? No. You know, they built, you know, both a great tool that was cloud enabled. Atlassian's product is on-prem, you know, at the time, this type of thing. And so they served actually a completely different set of customers. And so what you're really looking to ask your question is, how can I find a set of customers that are uniquely mine, that it's unusual for there to be other competitors for it? And sometimes that could feel easier, like I'm DocuSign and there just isn't a whole lot out there when I get going. Sometimes that can feel more difficult, like collaboration software. There's a ton of entrants. But that doesn't mean that there can't be a ton of great entrants, right? You know, you take Fuse. Fuse is just in the VoIP world, but they said, let's do a cloud version of VoIP as opposed to on-prem version of VoIP. Now they're replacing all the on-prem versions. And so you have to find your angle that means that it looks like you don't have competitors. And then if you want to continue to grow, you have to make sure that that market space is either big enough or that you decide you're like Bullhorn Software, where you say, you know what, instead of trying to step out of CRM for a very niche, right? I don't compete with Salesforce because I'm CRM for recruiting companies. Salesforce does not work very well for them. Bullhorn Software works really well for them. And you can make a decision. Do I try to pivot that into being, you know, niche CRMs for other people? Do I roll it up? Their whole space, even though it's very niche-y, many niches are much bigger than we give them credit for. And if you can get 80% market share, you know, the last time I looked at this, it looks like, you know, that space probably could support at least $800 million in revenue. And by the way, part of answering that question was also redoing pricing, because one of the biggest things we shoot ourselves in the foot with pricing is that we choose a pricing mechanism that's very difficult to understand the size of our market. Bullhorn has been valued multiple times in the past by one of McKinsey's competitors and through due diligences, because they've been owned by some private equity players like Vista. And I will tell you every time they came back with a different number, because it's actually very difficult to understand the size of the market because of the pricing unit they chose. Not because the market's hard to understand. So it's, you know, sometimes you can also shoot yourself in the foot for that.
Yeah, and by the way, if you're the number 3 or the 4 player in your space and you're not, you know, you're kind of barely eking it out there, the private equity guys are now competing with the strategics, and in some cases overpaying for what the strategics would be offering to buy talent and to buy these capabilities. So all is not lost if you aren't number 1, right? Want to caution you that you shouldn't just throw in the towel for whatever, you know, that means. So, okay.
Want to take another one?
Yeah. So what's the one thing or one metric that I should focus on to increase valuation at 15 million ARR if I'm only at 5 right now? That depends. I think there's a lot of things. That kind of assumes, at least it tells me, that you've achieved product market fit, right? You've got some, if it's recurring, then I would say, okay, good, that's a great sign. You've now starting to see some traction. You've got customers who are willing to pay. And these are probably going to be your, you know, MVP feature set, right? This is the early adopters. Those are the ones who are going to be willing to experiment with you, the pioneers in their space who believe that in the longer run, you'll have a roadmap that will have actual further kind of utility capabilities. At this stage of company, the growth is still very much your top concern. You've got to get to a point where you're able to hit some of these metrics that all the VCs traditionally look for, right? And Peter kind of showed you some of those early in the presentation. You want to try and race to get to that 50 million exit mark, and that's a long run, right? 10 times 5, kind of a time frame or a size multiple there. But growing is really putting really hard thought around how do I get product into the hands of customers, right? Whether you're selling directly over the web, whether you've got inside sales, BDR, SDRs, a direct sales force, a channel, whatever it is, you have to figure out what is the cheapest acquisition cost to get sales, right? And that's really trial and error. And you're going to start to see some data come back, and you'll have to experiment. You'll have to figure out your spend between sales and marketing. These are all the classic management challenges. So I would encourage you to do the SaaS radar, and we'll come back and we'll give you a more tailored answer to that question, if that makes sense. We'll actually then be able to see some of the differences in other companies at the 5 million mark.
Your one piece of advice to grow your company from 10 to 50 million. I mean, look, in the end, the word grow in there is obviously the most important one, right? You're going to need to grow fast. It's hard to give a single piece of advice because, companies are so varied and the situations they find themselves in are so varied. And when I look across the commercial motion, we already talked at the strategic end of decision making, right? But you get into the next stuff. There's a certain set of companies to have described the biggest market possible. They described a very horizontal value proposition or said, I'm building a platform. There's a way to make that way more efficient if you actually get targeted, right? If you look at what Twilio did to actually hit their inflection point, they went from 23 visionary value props to 3 very specific things that they could sell today. And yes, those were only 18% of their TAM, but hell yeah, they sold a ton of that, right? And so, there's things like that. When you get into the sales motion itself, right? As you're scaling the organization, is that organization like 2 or 3 excellent outbound sellers or inside folks? How is that organization going to look different when you have 15 salespeople? When should you start adding customer success people separate from them? Should you add some BDRs as opposed to just more outside folks? If you look in the sales motions themselves, the number of times I look in Salesforce and actually see the stages and I see that describe the behaviors the salespeople are making as opposed to anything about how customers are buying. And so that's why I say there's a lot of underlying aspects that cause some of that. And if you have some of those questions, I'd be happy to sit down and get to know the business or Junaid a little bit more, and we could talk about some of the things that we've observed from other people. But to a certain extent, there are, dissimilarities in many ways too. And so if I gave one piece of advice, it might work for 5% of you, but not for everybody.
Another question here is about what's our data show for average dilution at Series A, B, C for SaaS companies? Well,
we've stayed away from valuation questions, so we should
right.
just cut it off. There's a variety of reasons why we're trying not to dig in there. And by the way, certainly Silicon Valley Bank, Cambridge Associates, a bunch of other folks spend a bunch of time on those. There's some other even legal reasons the way we stay slightly further away from answering some valuation.
That's right. Our database doesn't actually track these, so we wouldn't be able to give you much insight there. What's the minimum growth percentage you need to achieve in your worst year you might have in order to become successful? That's a great question. I think we've seen some cases where companies have made pivots, right? They've actually had years where they've had to retool and change the business model, change the leadership. I don't know if there's necessarily, a lower watermark, if you will, for.
I will tell you. So if you look at the data, and this will be our last one, but it may be quite interesting for you guys. There are in the set of companies that made it to 500 million. There's a group of those companies that we called stallers. So they were a set of companies that had essentially one of these effects. And
we define that as 10% growth or less versus the super growers, which were 50% growth or more, right?
So they had a year where they stalled out because they were figuring something out. And this is an adjacent question to what you asked, but I think very indicative of the answer, which is, the crazy thing is those companies, if you took them out to 500 million and you asked at that point valuation question for this business, and you had 3 types of companies. You had one that never stopped growing fast. You had a company that had a stalling event and then started growing fast again. And you had a third company that grew fast to 500 million and then topped out, and you looked at their current valuations, what you saw is the most valuable company is the one that never stopped growing. The second most valuable company, surprisingly, is the one that's now growing the slowest. It's the one that grew fast and then topped off. And the worst valuation goes to that company who had a stalling year and has regained growth. And it's because when you actually look at the behavior of investors, and it starts to make sense if you put yourself in their shoes, they have no idea how good of a management team you are. All they can do is look backward. And they make the unenviable assumption that you don't know how to grow fast. So it's a little bit like your credit score. You see that it takes somewhere between 3 to 5 years for a slow growth patch to allow to be in the past with continuous growth to get back your full valuation potential as compared to others that are growing at similar paces as you that have never had that dip. And vice versa, those who had grown quite fast, the underlying assumption is these managers know how to grow fast businesses, and it was just a short-term issue, and that they're going to overvalue you, even if the forward-looking trajectory has a lot of questions in it. So slightly adjacent, but an interesting look at that. Hey, we ran out of time. You know, certainly, and you can go back to the presentation and put up our last slide. Feel free to email us. I mean, this is the stuff we geek out about all the time. We love smart, interesting questions. Happy to get to know your business better and, you know, see whether or not we can be helpful based upon, you know, having looked at a few hundred of these businesses and seen them through some interesting results. So,
Thank you very much.
thank you.